The first meeting is really a get-to-know-you meeting. We're going to sit down. Typically, the meeting will last about an hour. We're having a conversation. My job is to ask them some questions about where they are, what some of their goals are, what some of the key objectives they have in meeting with me, where they are to this point, and really what brought them in to see me. And now I'm at the point in my career where I have a lot of people that are dependent upon me to provide them with all the guidance and all the advice that we do on a day-to-day basis.
You spend your working years trying to build up your assets, trying to build up pension credits at your job, trying to grow your nest egg so that you can one day retire when you can't work or don't want to work anymore. And that's a period followed by phase two, which is retirement. And your priorities in these two phases are very different, but many times we see people don't make that shift and they still act like they're in phase one when they really should be acting like they're in phase two.
We're going to talk to you about what we commonly refer to as the second half of the game. And what I mean by that is you're working your entire life towards retirement, and I'm assuming that most of you are, at that age where you're starting to consider some of your options as you move into retirement. And as you do that, you're moving from what we call the accumulation phase of your life, where you're accumulating your assets. Maybe you're participating in your company's 401k, maybe you're contributing to an IRA account or a Roth IRA account or some type of retirement vehicle. And now, as you retire, you're transitioning into the distribution phase, or the part where you're going to need income in retirement. So we're going to talk about some different ways to do that with an emphasis on Social Security.
Good morning, and welcome to Financially Speaking with Jeff Bush. My name is Steve Jablonski. I'll be the host for today's program. Our topic today is advanced designations in the financial services industry. Specifically, we're going to focus in on the Certified Financial Planner designation, also known as the CFP. But before we get into real details on this, I'd like to welcome Jeff.
Well, hello, Steve. Welcome to the show, and it's great to be. This is our fourth year anniversary. It's hard to believe we've been here on the PCTV network for 4 years. It seems like it was just yesterday we were here doing our very first show in this very studio. And the reason, of course, why we started doing this is because not only are we here on the local cable, which is great, and of course I'd like to thank the people here at PCTV because they've been nothing short of wonderful while we've been here. But we've also been able to put our show out on our website, which is informedfamily.com, and also, the shows always stream on the PCTV network, which is the PCTVnetwork.com. So that's been a great experience. We're happy to enter into our what is now the start of our fifth year on PCTV. And of course, today we want to talk about some of the advanced designations and why that's important to our viewers. And of course, Steve, you are a certified financial planner, so it's great to have you in our organization, and it adds an element of expertise. So this is going to be a great show because we're going to talk a little bit about why this is so important to people that are looking for somebody to get financial advice.
And Jeff, we'll get into that in a minute, but I guess before we get into that, there's been an overwhelming response as far as the press publishing things from Informed Financial.
Yeah, so we really have been on a nice roll of late. I wrote an article a couple months back in the Reading Eagle on retirement. I was interviewed on U.S. News and World Report. Our colleague Barry wrote for Investopedia, and I believe you were featured in the Norristown Patch.
Yep.
So that's been a great experience. And of course, speaking of Barry, Barry, we're talking, of course, about Barry Waronker. Barry used to help us with this show here. He did a lot of the moderating of prior shows. But now, of course, Barry's on to other things, and he wrote a book, or helped write a book, called You're in Control. And he wrote the piece in that book relating to long-term care and how you address that very important topic. And we can actually, maybe a little bit later, we'll tell our viewers how you can get a copy of our book.
And as far as advanced designations in the industry, who holds what designations at Informed Family?
Well, so we all have our initials. So I, of course, have an advanced degree in finance, an MBA. And I also have a CLU, which stands for Chartered Life Underwriter, and a CHFC, which is a Chartered Financial Consultant. Both the CLU designation and the Chartered Financial Consulting designations came from the American College. Barry is a JD, which is Juris Doctor, which means he's got a law degree. And of course, you are a CHFC also. So you and I both have that designation, CHFC. And of course, you have the CFP designation, Certified Financial Planner, which is probably the most prestigious of them all. And that's the one we're going to focus on today.
Yeah. And if someone is not familiar with the CFP designation, what we like to compare it to is if we look at the accounting industry, and people have heard of CPAs, Certified Financial Accountants, and they have modules they have to test, and then a comprehensive test they have to take, very similar with the CFP, where there's 6 modules, and then 170 question, 2-day test, comprehensive test to get the designation. Okay.
Yeah, I mean, it's so the CPA, the certified public accountant.
Yes.
Certified public accountant, and the CFP is what's the designation in our industry, and of course, it is a very rigorous test, and it's not only getting that designation that's hard to do, difficult. You have to be very diligent to get that. But in addition to that, there's continuing education that goes along with it. So it's not like you just get the designation and you forget about it. You have to continue. You have to have certain amount of continuing education credits to continue to use that designation.
Yep. So let's get into it a little bit. There are 6 modules that are really taught in the CFP. So let's start. There's investment planning, income tax planning, retirement planning, and estate planning. So let's start a little bit with the investment planning, and maybe if we start there, what around asset allocation, and then how do you put in asset designation, and maybe some of the different asset classes?
Well, of course, with investment planning, this is the trickiest part, and this is what everybody's most interested in, is how we're going to handle the investments. So the first thing that we do is we assess a client's risk, and we have software that does that. It's called Riskalyze. It's proprietary software that we have, which really measures a client's propensity for risk. Then once we do that, then we can start to shape a plan. Yep. And the asset allocation is so important, because that's really how we designate all these assets so that they coincide with what your risk score is. So we have stocks, we have bonds, we have other asset classes such as real estate and maybe some precious metals and cash. So it's really a mixture of everything together that gives you your asset allocation and really helps to shape your risk.
And we look at the returns historically. Today's world's a lot different than, let's say, 1980 to 2000. What's the breakdown there, and what might be different about those two time frames?
Well, I always like to say this is not your father's stock market. And that is, if you look at 1980 to 1999, the market pretty much was on a straight bull run. It was pretty much an unprecedented 18-year bull run, which started, I guess, in 1982 and went right up until March of 2000. And there was something about the change of the century. Remember Y2K. Everybody remembers Y2K, or at least those of us that are old enough to remember that. It wasn't that long ago. But what has happened in the last 17 or 18 years is the market has been a lot more volatile, a lot more ups, a lot more downs. We've experienced two major recessions, two of the worst recessions in our history during that period of time. And the asset allocation becomes so important because if you don't have that and we hit one of those rough patches, it could really have a detrimental effect on your investment holdings, which could then have a ripple effect through your retirement plan.
And if we move on to the tax section, I know taxes change a lot over the years. Tell us a little about taxes, maybe what's tax-free, what's deferred.
Yeah, so with taxes, it really becomes an integral part of a financial plan because there are, you have your IRAs and your Roth IRAs and your 401k plans. These are all government-sponsored retirement plans, and generally speaking, they're tax deferred unless you have a Roth.
Yeah.
But let's just say that they're all tax deferred. So you have to figure out, well, what's the best way to defer your taxes and when's the best way to take your money out and pay your taxes. So the tax planning is really, really important. It's also important from the standpoint of estate taxes. When are you going to pay? Do you want to wait until death to pay your estate taxes, or do you want to? How can you save on estate taxes? So there's a whole element of planning that is involved with minimizing the taxes on your estate.
And when someone has a qualified plan, which is a retirement plan, and they turn 70 and a half, they're taxed on what they take out. What sort of strategies, like a Roth, would be to
so
lower
70,
that?
so the magic behind 70 and a half is that's the government induced age where you have to take a required minimum distribution, or what we always refer to as an RMD, required minimum distribution. So with an IRA account, let's just say for discussions today that the IRA is going to be used in a generic term to include any type of qualified plan. So it could be a 401k, it could be a 403b, but it's a qualified retirement plan. So with an IRA, there's a rule that says once you hit the age of 70 and a half, you have to start taking a required minimum distribution. The reason for that is because you can't defer your taxes forever.
Yep.
So the people down in Washington, they want their money. So at 70 and a half, you have to start taking a required minimum distribution. Now, the other magical age is 59 and a half. So once you turn 59 and a half, you can start taking a distribution from an IRA without having to pay a penalty. Okay, so if you're before 59 and a half, you're going to pay a penalty if you take a withdrawal.
Yep.
Once you reach 59 and a half, you can take a distribution from an IRA account. Pay the tax, but not a penalty.
Okay. And how is maybe the ordinary income rates in short-term and long-term capital gains? How do they differ?
Well, the way it works, how it's treated from a tax standpoint.
Yeah.
When you take a distribution from an IRA, it's treated as ordinary income.
Okay.
Okay, so on the tax return, you put it on as an IRA distribution on whatever line that is, line 16 of your tax
Yep.
of your 1040, and it's treated as a taxable distribution. Unlike if you're selling stock, you're either paying a short-term gain or a long-term gain if you've held the stock over a year, and if you've held it over a year, then you're paying long-term capital gains, which are at a lower tax rate than what your ordinary income would be.
Okay. And moving into retirement planning and income and retirement. A lot of advisors do retirement needs analysis. There's a whole bunch of different things. How does Informed Family look at a projection of income into retirement?
Well, what we like to do is we like to use asset cycle portfolio. So our asset cycle portfolio, what that does is it's also asset designation. And what that means is all those assets that you're holding in your portfolio have a very specific job, whether it's for immediate cash, whether it's for short-term income, short-term guaranteed income. Maybe it would be intermediate term. Maybe it would be income that you would need, maybe in the 5 to 10 year window of your plan. Could be income that you would need for long term. Or maybe it's what we call leave-on money. In other words, it's money that we never intend to spend. It's money that we're going to. It's either there for a long-term emergency, such it could be there to cover a long-term care risk, or maybe future inflation, but most likely it's there for your legacy. It's there for your family. So with this asset cycle, it's to the plan because we have to then put these assets into certain asset classes through this asset designation to meet all of our financial goals, whether they're short term or whether they're long term.
Yeah. And you mentioned earlier about costs and about 401ks. How are they treated tax-wise when you contribute to them?
Yeah, so the Roth is actually a brilliant and I think underused way. The money that you put in grows tax-free lifetime, and not only over your lifetime, but over the course of the lifetime of your beneficiaries. So say your children. So you're basically getting 2 lifetimes worth of tax-free growth. It's a wonderful thing. I mean, it's beautiful. When you figure, that could be another 80 years, the life of you and the life of your children. So that's a very effective way to build your legacy. The other thing with the Roth that I want to mention is back in 2010, they built it into the Tax Act of 2010, where you could contribute to a Roth inside of a 401k. So instead of your traditional 401k, where you're getting tax deferral, you're getting a Roth 401k, where you're not getting a tax break going in. You don't get any tax break going into a Roth, but you get tax-free growth. So in essence, the comparison is you're being taxed on the seed rather than being taxed on the crop. Yeah. So you can build a lifetime, 2 lifetimes worth of tax-free growth with a Roth.
And over the last 20, 30 years, we've really seen the environment in retirement change, meaning who had pensions, what do we have now? Can you tell us a little bit about what it looked like 30 years ago versus what it looks like today?
Yeah, well, just like it was, this is not your father's stock market. This is also not your father's retirement. Just a generation ago, when people retired, they retired with a pension, and they retired with Social Security. Those were all fixed sources of income. There weren't a lot of moving parts. We really didn't have to worry about managing risk in the stock market. It's very different today, because when you retire today, hopefully you'll have Social Security. Well, Social Security is going to get, statistically, Social Security gives you about a third of your income. Okay? So where's the other 2/3 come from? In most cases, it's not coming from a pension. The pension is dying. You know, unless you're a government employee, if you're working in the private sector, by and large, those pensions are no longer there. So what happens is you have to rely on your investments inside of your retirement plans, your 401ks. And what you don't want to have is the quality of your retirement based on the performance of the stock market.
And traditionally speaking, when you were a participant in a 401k, you could not get that money out or move it until you were separated from the company. What's that look like today?
Well, and this is a general statement here that I'm going to make, but generally speaking, you can do an in-service, what they call an in-service rollover when you're 59 and a half. So that same cutoff of when you can take a distribution from an IRA also applies generally to a corporate retirement plan, where if you're 59 and a half, you can do an in-service rollover. So let's say you're still working for your company and you have a 401k, you're still contributing, maybe the company is still matching, but you can start your retirement planning. You can do an in-service distribution or an in-service rollover, take money out of your 401k, roll it over into an IRA, and start your retirement planning.
Okay. Now let's say your clients, they've saved well, they invested well, they were smart tax planning, they're all set for retirement planning. Let's go into estate planning a little bit, okay? And maybe what are some general strategies or documents that, you know, our clients don't want to give more money to the government than they give to their kids?
Well, first and foremost, with estate planning, I mean, there's a lot of things that you really need to do. The first thing you need to do is you need to have a will. Okay? You have to have a will, you have to have power of attorney documents. Those are basic things, and we're not attorneys, so you need an attorney to do that. But it's really important because you don't want somebody else figuring out your legacy for you. You want to control that yourself. So that's important. The other thing that's important is beneficiary designations on all these accounts. All these things that we talked about today, Steve, require beneficiary designations. So you want to make sure your beneficiaries are correct. Is it your spouse? Is it your children? You also want to have contingent beneficiaries. So typically, you would name your spouse as your primary beneficiary, and then in the event that your spouse would predecease you, you want to name your children as contingent beneficiaries.
And why would you need, I mean, what's the main purpose for the wills? Like, why is it to transfer wealth, or?
Well, it's transferring wealth is certainly part of
Yeah.
it. It's really to carry out your final wishes. So it's really to transfer wealth. It could be, if you have minor children, it could be the guardianship of your minor children.
Okay.
But that's the importance of having a will, because it's your will. If you die without a will, so let's just take Pennsylvania for example, because we're sitting here in Pennsylvania today. So in Pennsylvania, if you die without a will, then the state determines how your estate gets distributed.
Yeah.
Well, that may not be what you wanted.
Yeah.
Because they have their own guidelines where they decide how the assets get distributed. So it's really important. And then, of course, if you have a large estate, then there's some advanced planning that you need to do with trusts.
Okay.
To minimize the impact of estate taxes.
And with the modules surrounding this certified financial planner, how does that tie into Informed Families Plan First?
Well, we feel very strongly about our role as a fiduciary. Okay, so fiduciary quite simply means you're acting in the best interest of your client. So, we talked a little bit about having a will. Well, when you have a will, you have somebody who acts as the executor to the estate.
Yeah.
Okay. Well, the executor to the estate is acting in a fiduciary capacity. They're acting in the best interest of the beneficiaries of that will. This is the same thing in our practice. When we have our clients come in and we're managing their affairs, their assets, their insurance, whatever we're doing, we have a fiduciary responsibility.
Yeah.
So those designations that we have, more importantly, the fact that we're all registered investment advisors, we have that built into our responsibility to act in a fiduciary capacity. So all this legislation that's going on right now with the Department of Labor trying to legislate us to act in that fiduciary capacity, we're already doing that.
Great.
We're already acting in that fiduciary role. We're already acting in the best interest of our clients. One thing I want to mention too as we're wrapping up here today is we take the show on the road. So it's not we don't just sit here in the studio all month and do these shows. We go out into the real world. We're going to be, we do it here in Pottstown. We're in Lily's Grill. We're down on Egypt Road, which is near our other office in Norristown, at Chadwick's. So we encourage you to contact our office. So we're going to put the phone number up on the screen. So if you want tickets to one of our events, give us a call. Also, if you want a copy of Barry's book, we're going to offer that free to anybody who wants it today. So just call that number up on the screen or send us an email at info@informedfamily.com. And if you want more information on anything we talked about today, on the CFP designation, if you want to come to one of our live events, if you want a copy of Barry's book, just simply give us a call or send us an email. With all that being said, Steve, we're going to put the wrap on another great
Okay.
show here today, the CFP, and maybe the next time we'll talk about one of the other designations that we have. But for now, this is Jeff Bush, and this is Financially Speaking.